El primer principio es la excelencia en el rigor. Para batir al mercado hay que hacer algo distinto. Hay que llevar la contraria. Hay que tener lo que se llama active share o tracking error y además hay que acertar. Pero el camino al acierto está lleno de trampas. Para acertar hace falta depurar datos históricos, separando lo que es ruido de lo que es señal, para entender por qué pasó lo que pasó. Pero esto es solo el comienzo, porque lo que importa es el futuro, y una empresa es un sistema complejo de interrelación entre partes en constante cambio. Las preferencias de los consumidores cambian, las maniobras de los competidores cambian, la actitud de los reguladores cambia y la tela de araña de fines personales y societarios de sus directivos cambia con ellos. Y cada cambio tiene la propiedad de que puede o no afectar al resto de partes. Por eso hay que monitorizar constantemente el cambio de cada una de esas partes y establecer relaciones de causalidad fiables, como decía von Mises, para entender cómo el cambio de la parte afecta al todo. Cuando hablamos de la excelencia en el rigor como principio de Azvalor, nos referimos a la regla autoimpuesta de un rigor permanente en los modelos, un rigor permanente en el examen del pasado, un rigor permanente en el cálculo de probabilidades futuras y un rigor implacable en el reconocimiento de nuestros errores. Un rigor que muchas veces nos obliga a responder sencillamente «no lo sé». Esta excelencia en el rigor nos la autoimponemos porque nos lo jugamos todo. Todos nuestros ahorros están en los mismos productos que los de nuestros clientes, porque creemos que esto marca radicalmente la diferencia. Es el famoso skin in the game, nuestro segundo principio. El tercer principio es el equipo. Son muchos los estudios que han demostrado que surgen mejores pronósticos cuando el experto pasa de trabajar en solitario a juntarse con otros expertos. El cuarto pilar es la necesidad de humildad. Una humildad sincera que parte de aceptar que la realidad es sumamente compleja, que la historia pudo haberse desarrollado de muchas más formas a como lo hizo y de que el futuro aguarda miles de escenarios posibles, de los cuales solo uno acaba materializándose. Una humildad que permite reconocer los errores de inversión, que permite vivir con la certeza de más errores en el futuro y que permite escuchar la opinión de las voces discrepantes como condición necesaria para fortalecer el razonamiento propio. Y se preguntarán, ¿por qué los empujo a desayunarse hoy con 4 principios de Azvalor? Pues porque son los que nos han guiado en la gestión de nuestros fondos y porque son los que nos han guiado en la confección de nuestro fondo de managers. Pensemos, mirando la transparencia, de forma genérica, cómo encontrar un gestor que bata al mercado en el futuro con una alta probabilidad. Primero, en primer lugar, la C1 debería ser un contrarian. Solo hay un 10% de gestores que lo son hasta sus últimas consecuencias. Hablo de aquellos que tienen un active share del 90%. De ese ramillete de contrarians hay siempre un porcentaje reducido que lo son sin convicción y el mercado con el tiempo los expulsa. Parece lógico pensar que un 90% tienen una enorme capacidad de trabajo y la excelencia en el rigor como norte. De los que a la vez son contrarian y rigurosos, habrá un porcentaje reducido que se lo acabe creyendo y que acabará pagando sus consecuencias, pero son una minoría y estimamos que un 90% reconocen la necesidad de humildad en el sentido de humildad que acabo de describir. Como muestra la transparencia, la probabilidad condicionada de estos 3 criterios, es decir, que se den a la vez el ser contrarian, excelente en el rigor y consciente de la necesidad de humildad, es del 8,1%. Muy parecido al porcentaje de gestores que bate al mercado, según las estadísticas, entre el 7 y el 9% en función de la fuente o del periodo analizado. Cuando Javier descubrió a Adam y a Leigh, Azvalor llevaba 2 años invirtiendo en materias primas. Tras su detallado due diligence y nuestro recorrido en el sector, reconocimos en ellos todas las características del gestor soñado y nuestros 4 principios dándose la mano. Adam y Leigh son contrarians de pura cepa. Leigh predijo públicamente en julio del 2000, cuando el oro estaba a $278 por onza, que se iría a 2.500. Muchos se rieron, pero en 2013 el oro rozó los $1.900. Adam y Leigh son un equipo que se complementa tras más de 10 años trabajando juntos. Adam y Leigh tienen una excelencia en el rigor que queda patente en cada uno de los razonamientos que hacen, como espero hoy tengan oportunidad de comprobar, si no lo han hecho ya, leyendo sus cartas trimestrales. Adam y Leigh destilan en sus pronósticos esa humildad de la que acabo de hablar. Adam y Leigh son, a título personal, dueños de más de un cuarto del dinero que gestionan. Tienen skin in the game y yo diría que tienen incluso soul in the game. Ponen su alma en lo que hacen. Fíjense la transparencia un último segundo. Dividan por dos el punto 2 y el punto 3, la E y la H. La experiencia, la excelencia y la humildad, la excelencia en el rigor, perdón, y la humildad. Y vean cómo la probabilidad de batir al mercado se desploma hasta 4 veces menor. No caben ni la complacencia ni la soberbia en este oficio. En los intercambios que hemos tenido con Adam y Leigh, hemos podido comprobar su capacidad insaciable de trabajo y rigor en los altos como en los bajos, así como esa humildad que les empuja a revisar y comprobar continuamente cada eslabón de su tesis a la luz de la nueva información que va emergiendo. Por todo ello, los incorporaremos a nuestro fondo de managers con la máxima ilusión, esperando sinceramente que ustedes entiendan enseguida por qué. Muchas gracias.
Quería comentar muy brevemente lo que es el fondo de managers para aquellos que aún no lo conozcan y luego haré una pequeña introducción sobre ellos. Cómo va a funcionar el día de hoy es, primero, Leigh nos va a comentar las tesis de inversión sobre las materias primas y va a estar un rato explicándolas en detalle. Luego vamos a pasar a un formato más entrevista en el cual yo les voy a hacer preguntas a ambos. Y luego, por último, tendremos preguntas del público. Para ello, pues, tienen tarjetones, también hay un par de micrófonos, pero vayan, si quieren hacerlo por escrito, nos las van pasando y nosotros las iremos preguntando a ellos dos. Entonces, decía que voy a explicar muy brevemente lo que es nuestro fondo, ¿no? Y como ya hemos hablado de ello en las últimas semanas, voy a ser muy breve. La idea del fondo es, de alguna forma, buscar las mejores oportunidades de inversión, las mejores compañías que podamos encontrar en diferentes partes del mundo, ¿no? Y como sabemos que no hay ningún equipo de inversión en el mundo que tenga capacidades infinitas, ilimitadas, pues queremos delegar o apalancarnos en la buena labor que hacen diferentes gestores que hemos encontrado, ¿no? ¿Y qué características tienen que cumplir? Pues como decía Álvaro, al final tienen que ser similares a Azvalor en la forma de hacer las cosas, ¿no? Queremos que sean gestores vocacionales, es decir, que disfruten de lo que hacen, que sea su pasión de vida, ¿no? Queremos que sean, digamos, muy especialistas, que no hagan renta variable americana y pasado mañana hagan renta fija australiana, ¿no? Queremos que sean gente que haga una sola cosa y que la haga muy bien. Queremos, por supuesto, que tengan skin in the game y los 4 managers que forman parte del fondo son dueños de las compañías en las que trabajan y además invierten su propio patrimonio en las estrategias que gestionan. También queremos, por supuesto, que en cuanto al estilo de inversión, que sean, digamos, analistas fundamentales, que miran las compañías de arriba abajo, que las conocen muy en profundidad y que hacen al fin y al cabo un stock picking con una mentalidad contrarian, como decía Álvaro, y con una mentalidad muy largo plazo, ¿no? Para que esas, digamos, convicciones contrarian pues, se materialicen en buenas rentabilidades a lo largo del tiempo. Queremos que sean pequeños, que no gestionen una masa de activos demasiado elevada y que tengan muy en mente pues, que sus productos tienen una capacidad limitada y que pues, cerrarían sus productos si esa se alcanza. Y, por supuesto, pues, que tengan rentabilidades extraordinarias, ¿no? Y en ese sentido, pues, los 4 managers que tenemos pues, cumplen con todas esas características. Y ya en cuanto que es Goehring y Rozencwajg, ¿no? Y ahora vais a tener una experiencia directa con ellos, ¿no? Pero quiero explicar, Álvaro ha indicado algunas líneas generales, yo voy a dar algunos datos un poco más específicos de dónde vienen, quiénes son. Adam Leigh, perdón, es seguramente el gestor de recursos naturales con más experiencia del mundo, lleva gestionando dinero en este área desde el año 91. Leigh contrató a Adam en su segunda etapa en Chilton, donde gestionó un fondo que alcanzó 5.000 millones de dólares. Contrató a Adam, como digo, en el año 2007, luego llevan trabajando juntos 11 años. Lanzaron su propia gestora en el año 2015, a finales de 2015, más inicialmente como un family office, casi gestionando su dinero y el de familiares y amigos, y en 2017 ya abrieron, digamos, al público externo su estrategia, ¿no? Ahora mismo gestionan un volumen muy limitado de activos, en torno a 40 millones de dólares, que yo creo que da un poco idea de lo deprimido, ¿no? Que está el sector, donde nadie, es un sector donde parece que nadie en el mundo pues, está mirando para invertir en él, ¿no? Además, cuando crearon la compañía, pues contrataron a un director financiero, director de operaciones, que tiene 40 años de experiencia, se llama Goehring. En los últimos 15 años fue el director de operaciones de una compañía americana muy conocida, una gestora muy conocida que se llama Neuberger y como digo, pues juntos crearon esta aventura. El proceso de inversión, que ahora conoceréis más en detalle, pero combina dos elementos. Por un lado, un análisis más top-down, ¿no?, de cada una de las materias primas y hacen digamos, su análisis además extensible al público, que es muy interesante y seguro que algunos de los que estáis aquí lo habéis leído, ¿no? Y es de hecho como nosotros llegamos a ellos, ¿no?, leyendo sus informes, sus análisis, dijimos, bueno, estos gestores son muy potentes, vamos a ver qué hay detrás, ¿no? Y cuando fuimos a ver lo que había detrás, pues nos encontramos con todas esas características que buscábamos. Y luego, en cuanto al track record, ¿no?, que mencionaba anteriormente, la estrategia de Leigh ha generado casi un 10% anualizado neto de comisiones, batiendo, por supuesto, a la inmensa mayoría de los competidores. Para poner un poco en perspectiva, ¿no?, ha batido al Bloomberg Commodity Total Return Index por un 7,5% anualizado, de nuevo neto de comisiones, y ha batido al peer group de Morningstar de fondos de recursos naturales por más de un 5% anualizado neto de comisiones, ¿no? Y bueno, hay que tener en cuenta que desde el año 91 hasta ahora, pues 27 años de track record y además habiendo pasado 3 de crisis muy severas dentro de este sector, ¿no? Como fueron la del 98, pues 2008, que fue un poco más generalizada, y luego la de 2014-2015. Ya con eso voy a darle la palabra a Leigh y, como digo, pues luego pasaremos a un poco más formato de entrevista con preguntas por mi parte y por la de todos.
And thank you for coming out this morning to listen to me talk about commodities. It's a fascinating time to be a potential investor in the commodity space today. As most of you know, over the last 7 or 8 years, commodities have been through a huge bear market. Investors have become unbelievably pessimistic about the future of oil, other related commodities, things like that. And what that pessimism has produced a tremendous amount of value in this space. Enough value that for those investors that are willing to make those investments today, and I guarantee you, in the world in which Adam and I live in, very few investors are willing to make that investment choice. But if you do, I believe spectacular returns await you. Maybe not tomorrow, maybe it takes a while because we're in a bottoming process right now, but I believe that the potential returns for investors that are willing to make the investment today will be spectacular. And to prove my point, or to give some validity to my point, what I want to do is I just want to show you this chart. And I think many of you probably have seen this chart in various financial publications. We've been using it now. It's been collected from a lot of data points. This one that you see is our proprietary one. And what it does is it shows that over the last 100 years, that financial assets and commodity prices go through these long cycles. And often these cycles happen, commodities and financial assets, their returns are uncorrelated, and usually they're inversely correlated. Financial assets become very popular. Commodities enter into a bear market. Financial assets become overvalued. They enter in a bear market. Commodities enter into a bull market. And I think it's interesting to give you comfort that we're at the bottom of the cycle. I thought I'd go back over the last 100 years and talk about each one of these periods at the bottom of the charts that are circled, where commodity prices were extremely undervalued. What characterized those periods? What brought them about? And then, are we in that position today? Because each one of those times in the late 1920s, this is hard to believe that even in the late 1920s, with the Great Depression in America about to happen, commodities radically outperformed financial assets over the next 15 years. I mean, obviously, because of the Depression, we didn't really get a really bull market in commodities, but they did radically outperform. So if you bought commodities in 1929, if you bought commodities in the late 1960s and 1970s, if you bought commodities in the late 1990s, you would have done spectacularly well relative to financial assets in general, and you would have gotten very positive returns in doing so. So what characterized each one of those periods? First, let's go back to the 1920s. The 1920s was a period of intense deflation in commodity prices. From their peaks after World War One, where commodity prices had gone, were extremely strong because of the war. They proceeded to fall from peak to trough by almost 70%. So what's interesting is that before any real commodity bull market begins, you have to have a huge drop in commodity prices, and I'll talk about why that's important in a minute. In the late all the way through the 1960s, commodity prices didn't fall, but the problem is that inflation on a global basis began to accelerate rapidly, about 2.5% per year for 15 years. What did that do to real commodity prices? From the late 1950s to 1970, commodities in real terms fell about 75% in price. In the late 1990s, from their peaks reached in 1980, in real terms, commodity prices had one of their biggest declines ever. They fell almost 85% in real terms. And this cycle, from mid-2011 to today, commodity prices have fallen about 65 to 70% on average. Now, why is that important? Well, what's interesting about the 70s, the late 60s, the late 1990s, commodity prices fell so far that in many commodity industries, somewhere between half to three-quarters of the producers in those commodity spaces were losing money. Not only were they losing money, but they couldn't justify making reinvestments in their business to keep themselves at growing concerns. So therefore, if the commodity prices had stayed that low, like I said, back in 1999, when oil hit $11 a barrel, I said, if oil stays $11 a barrel over the next 10 years, we will not have a global oil industry. Not one project in 1999 could go forward at $11 a barrel and earn anything greater than a 0% return. Same in the gold market, same in the copper market. All across the spectrum, every commodity price had fallen so low that you just couldn't make an investment in that industry anymore. So you guaranteed almost a pinching and a slowing of supply as reinvestment couldn't be made. So each one of those cycles, previous cycles, commodity prices had fallen that low. What's happened in this cycle? Go back to January of 2016. Oil fell down to $27.50 a barrel in Brent. WTI fell down to 26.5. At 26.5, there wasn't one project in the global oil business that could go forward. We've all heard about the shales, what wonderful they are. I guarantee, and we follow the shales exclusively, at $26 a barrel, not one shale project could go forward. Not one project in the whole world. Copper, when it bottomed at $1.98 a pound, that there was not one copper project in the world that could go forward at that price. The gold markets, it's interesting, gold is, I think it's another commodity, and we can talk about gold later for those that are interested, because it's a market that we really follow, as well as oil and everything. Under $1,200 an ounce. Again, you see how miserably the gold stocks have been doing over the last couple of years. Why? Because if it stays at $1,200, there's not going to be a gold industry in 5 years or 6 years. These companies are in the process of liquidating, and they're running off their projects today with very, very little positive return. So in each one of those cycles, commodity prices fell significantly. Each one of them, the commodity prices fell to the point where huge parts of the commodity industries couldn't go forward at those prices. Another good example today, uranium. We love uranium. Do you know that when uranium hit $18 a pound earlier this year, that 75 to 80% of the entire industry is operating at cash loss? That's the type of what makes a market bottom, and we have experienced that cycle. So that's number one. Number two is a little less intuitive. But each of these cycles, the 1920s, the 1960s, the 1990s, and today, have been all characterized by extreme and excessive monetary creation. And for some strange reason, that excess monetary creation doesn't wind up in the commodity market, it winds up in the financial markets. Obviously, the 1920s, you had Britain went back on the gold standard at the wrong rate, and the United States, in order to try to save the British pound, aggressively tried to lower rates and it was the first attempt ever at what we know today as quantitative easing. And That was a huge monetary experiment that created a lot of excess credit. The 1960s are very famous because the United States was fighting the Vietnam War, was trying to expand its social programs, huge amounts of excess monetary creation. The 1990s, Alan Greenspan, he faced multiple global financial crises all the way through the 1990s, and his response to each one was to print more and more money. And finally, this cycle, we could talk about why this is true, but if that's another necessary condition for a bull market in commodities to start, think about what we've just been through the last, last 10 years. We've had the Federal Reserve in the United States undertake 3 completely unconventional monetary policies, 3 massive periods of money printing through the term quantitative easing. Not only has that quantitative easing happened in the United States, but it's been emulated by the European Central Bank and the Bank of Japan. We have printed more money than in any cycle we've ever done. So if that's a necessary precursor for a bull market to happen, that has been put in place on steroids today. And finally, one of the most interesting things, and it's probably related to the excess monetary creation, previous to every bear market bottom in commodities has been a massive speculative binge in financial assets. Of course, we all know about the 1920s, which was probably brought about by Benjamin Strong's money printing. Financial assets took off in price. You had the tremendous parabolic blow-off in the stock market in 1929. The 1960s saw multiple periods of financial crazes take place. There was the conglomerate craze, there was the Jerry Sein mutual fund craze, and then finally there was the Nifty 50 craze, where literally you had 50 stocks in the United States that traded at PEs of 50. That's how expensive the market was, all happening as the commodity bear market ended. Dot-com bubble, late 1990s, classic market mania. In fact, by 2000, the US stock market had become the most expensive that it had ever been. This cycle, we've had multiple crazes in financial speculation, whether it be cryptocurrencies, whether it be the FANG stocks. Amazon.com is up, 15,000%. We have 3 companies now that have trillion market caps in the United States. And now we have a brewing cannabis craze beginning to happen in North America as well. So we've had, if both monetary printing and related financial speculation is necessary for a bull market to start, we have definitely been, those conditions are definitely in place. So that's where we are now. As you can see, commodity prices are just about as undervalued as they've ever been. Commodity prices have fallen to the point where in many industries, 3/4 of the industry now can't justify any sort of reinvestment whatsoever. 2, all that money that's been printed, for whatever reason, has gone into financial assets. But what happens is eventually all that money printed winds up going back into the commodity markets. That's what causes the commodity bull market. So we've had this monetary printing binge that we've been on is unprecedented as of today. And third, ironically, before the commodity bull market starts, you have to go through a full-blown period of financial speculation. And this period of financial speculation that we've had over the last 4 or 5 years, especially related to the FANG stocks in the United States, has been truly impressive. So you have definitely laid the groundwork for a bull market to happen in commodities. Like I said, this is an asset class that no one owns. I've been doing this now for 30 years. My background, you should know, is both my parents used to work for Exxon. And so I grew up just hearing stories about the oil and gas industry and things like that. My father first started, before he went to Exxon, worked for Chevron. His boss at Chevron was one of the men that went to Saudi Arabia back right after World War II and discovered the great Saudi oil fields. And my father used to tell me these stories growing up. It's a field that I've studied and I loved. And let me tell you that I go out there today and talk about this story, and no one is interested. And that's where the opportunity is today. And that's why I think that for those that are willing to make this investment, the returns will be spectacular.
Leigh just explained his interest or his kind of family tradition on the natural resources space. I'd like to turn to you, Adam, on why did you decide, or why did you become interested in working with Leigh and being so focused on the natural resources space?
Sure. Well, good morning, everyone, and thank you for having us both today. I was first introduced to Leigh 11 years ago now, but actually I've known his family and his wife for longer than that. When I was in university, I was a summer intern one summer, and I worked for Leigh's wife, Sandy Pomeroy, who's also a fund manager at Neuberger Berman. And I was, at that point, 20 years old and still in college, and I learned so much and had a fantastic experience there. And afterwards, I went on to investment banking for a few years, and eventually, Sandy always maintained a mentor role to me. And when I wanted to move to the buy side, she suggested that I reach out to her husband, Leigh, and she said, I think you guys would get along very, very well. I met Leigh in the fall of 2007, and immediately when I met him, I said, oh my God, this is somebody who I want to work for the rest of my career if possible. Just the way he approached the markets, the way he was a student of financial history and of resource history appealed to me very, very much, and to me was something that was very rare in the investment management business. And so I started working for Leigh in 2007, and we've been working now together for 11 years. And
so it's going well, I guess. So, Leigh, I have to say that I'm a little bit disappointed because you didn't bring your cowboy hat today.
It's in the room right there. I will promise to put it on before I finish.
But more seriously, Leigh, I'd like to share with the audience why did you decide to, both Adam and yourself, leave a company like Chilton, where at its peak you were running $5 billion in assets. Why did you decide to quit that maybe more comfortable life and create your own new company back in 2015?
It's interesting. I started investing money in the natural resource and commodity space exclusively back in 1991. That's when I started. And for years, I ran a long-only mutual fund, very, very successfully, the Prudential Jennison Natural Resource Funds, which are still doing very, very well today, even though I haven't been there in 15 years. And going to Chilton, obviously we're doing both long and short, and managing a both long and short book. And I just decided that my great strength is really more on the long side. And the idea that we did very, very well in our shorts for a very, very long time period, but it's a very, very difficult, we talk about managing a hedge fund, but it's a very, very difficult thing to do. And I was at Chilton for 11 years, and we did very, very, very well. But it was just time for me to move off and go back to my roots, something that I really like doing. I really like researching, doing deep research on global commodity markets, and we can talk about some of our research later, and being able to apply that research on a long-term basis, on a very low turnover basis, which, as you know from hedge funds, that's sort of all anathema to being a hedge fund, frenetic activity all the time. It wasn't playing to my strengths. So after 11 years at Chilton, it was very, very difficult because they didn't want me to leave. We were an integral part of the Chilton organization. But I just decided it was time to do something, go back to my roots, to something that I really love.
Mm-hmm. And obviously you share ownership in the company, and you also share responsibilities in the final decision making, so it would be interesting to understand how you work together. I mean, how final decisions are made in the portfolio, and in that regard, how is kind of a standard day in the office,
Sure. Yeah, so Leigh and I share a lot of responsibilities, and in a lot of ways that's been sort of similar to how we've worked forever, in the sense that Leigh and I have always sort of modeled all the companies together. Back when I was a junior analyst, as much as today, we look at all of the fundamental research from the top down together, and really sort of everything is done collaboratively as a team, much as it has been. I should point out that many hedge funds, operate sort of a large team with 20 analysts, and there's an investment committee, and they all have to pitch their ideas. That was never the case. At our most, we were a team of 3, and for the most part, Leigh's actually worked alone. So it's really always been a very collaborative effort where we've sort of looked at things together, gone down the path together, and made decisions together. I always defer to Leigh if we have a difference in views, but I have to say in 11 years, I think it's very rarely happened, because either I'm able to convince Leigh of my frame of mind or he's able to convince me. We look at the world in a very similar way, and so it's very rare that we've fundamentally disagreed on anything. But I think ultimately, I defer to age and experience, and if ever we did disagree, Leigh would have the final say on anything.
One of the things that we do in our research process, which I think is very interesting, is that when we research a commodity market and we decide, okay, say it's the end of a bear market, it's going to turn into a bull market, what signposts, what mile markers do we have to pass in order to convince us that we're on the right road as far as the direction of this bull market is going? So it's interesting. We decide beforehand, what are the mile markers that are, what should we look for? And the thing is if we don't pass them, then we've already set out before we even start that this is something that we're going to agree on. If we don't pass it, then we were wrong, and things like that. So I think what the way we structured the research and investment decision-making of the firm is to try to draw on both of our strengths and put them together, and try to put together a framework in which we have these literally these mile markers in everything that we do to see whether we're right or wrong.
Mm-hmm.
And I'll just give a brief example, because it's so important to everything that we do, because we take a very different view than a lot of our competitors about the commodity markets, and we make very differentiated calls, both from the top down and bottom up. And we need to have, like Leigh mentioned, these mile markers to tell us if we're going in the right direction, so that so we're able to maintain our positions in difficult times. So for instance, going all the way back to 2016 and 2017, one of our views was that the oil market was much tighter than believed. And if that's true, then inventories should stay flat and begin to decline. And they started to do that. And so to us, that was a sign we were on the right path. Now, oil has suffered 2 major corrections since then, notably, obviously, at the beginning of 2016 when it bottomed, and then again in the summer of 2017. And we stood ready to make investment decisions and add to a lot of our positions, in that case particularly in the offshore drilling stocks, because we had a great confidence that the fundamentals were still going in the right direction. And so we could use that to our advantage. But if we didn't have these sort of checkposts or checklists along the way, it'd be very, very difficult to know if we were right or if we were just ultimately wrong.
Maybe you can expand a little bit on the oil sector. Obviously, you've been bullish on it for a while. It's come down almost 30% in the last few months. So what's giving you conviction on the sector, and what do you think lies ahead?
One of we're a research-driven firm, and I like to say to people that some of the research that we do in various commodity markets is the best that's out there. And what we're trying to do is we're trying to identify trends that we believe exist that no one else quite understands. And there are 2 major trends at work in global oil markets today that people don't quite appreciate their strengths. And it's what makes us bullish. One is demand. Now, there's a lot of talk because of Trump-related trade wars, et cetera, that demand is going to slow significantly from here. We have done a huge amount of work on global oil demand over the last 10 years, and I hope that some of you have had a chance to read it, because it was unique. No one wrote it. When we started writing about this 7 or 8 years ago, no one was writing about it. And that's that there's a phenomenon that takes place in emerging market economies when they reach a certain level of per capita GDP, that their intensity of oil consumption goes up. And this is something that we can empirically measure in just about every emerging market in the post-World War II environment. Well, it turns out, starting about a decade ago, there was an explosion of people in the world, in various countries, that were entering this period. And of course, what has happened since then? The IEA, the International Energy Agency, has underestimated global oil demand by almost 1 million barrels per day per year over the last 10 years. Why? Because they've missed this phenomenon that I just described, that the emerging market economies now represent a huge amount of oil consumption in the world. Now, here's something else. That's a trend that we believe is going to continue. For example, the IEA has global oil demand next year, 2019, about 1.4, 1.5 million barrels a day. Our models tell us it's going to be close to 1.9. The big wild card that's going to happen is not going to be China, it's going to be India. People aren't writing about India, but India, you know, we've been to India many, many times over the last 20 years, studied it intensely, and India, we believe, is where China was back in like 1998 to 2000. And India's oil demand is growing 330,000 barrels a day year over year. It's the world's second largest line item growth out there. So that's going to be one of the areas that's going to really push demand. However, what's interesting is that, and what no one's talking about, is that there's going to be a dramatic slowdown of non-OPEC, non-US oil supply growth in the next several years. And you know, you've probably seen these charts that have appeared in some of our work. The size of new discoveries in the last 15 years in conventional oil have collapsed. The amount of capital spending that's gone in the upstream global oil business has collapsed. And so the funny thing is, we all think that this is not going to have impact on global oil supply. Our research, and we've modeled it, and we've outlined our modeling, what we've done, and the methodologies that we use. We believe that non-OPEC, non-US oil supply is going to radically disappoint in the starting next year. And how much will it disappoint? The IEA for 2019 has non-OPEC, non-US oil supply up 600,000 barrels a day. We think it could be zero, according to our modeling. So you've got 400,000 barrels a day of excess demand in our models. You have minus 600,000 barrels of lost supply versus the IEA. Now, all of a sudden, we've got a market that's all naturally back to tight, just on its own fundamentals. And this is before I think that OPEC will cut. So I suspect that we're going to have this pullback in oil prices will be, in retrospect, be seen as a great buying opportunity, because I think that the tightness is going to come back into the market in 2019. And this is you know, between Trump and tricking the Saudis into producing more oil, and then, you know, not implementing fully the Iranian sanctions. So we've created a little disequilibrium here, but it's a buying opportunity.
Mm-hmm. And you mentioned that you've traveled to India several times in the last few years, and I know that you traveled also earlier this year, and you were kind of investigating a little bit the electrification development, amongst other things, yeah. Which relates more to copper. So maybe you can give us a little bit of you know, your views on the copper sector.
We're very bullish on copper.
Yeah, I know.
Yep, and copper is our largest theme outside of energy. It's our highest conviction belief as far as metals go today. And a big part of that story is India. We have looked at how much copper is required in an economy of a given size, and it turns out that as a country gets wealthier and larger, as you might expect, it needs to have more copper installed per person. China, for instance, has about 110 pounds per person installed in things like transformers and electrical lines and pipes and wiring. And that's exactly where it ought to be for an economy of its size. In the United States and certain countries in Europe, it's about over double that. And so we see that as a progression that's going to continue. India, at the same time, is only at 10 pounds per person of copper installed in the economy, so it's incredibly low. And if you expect that a country like India will have to eventually go from 10 pounds per person today up to the Chinese level of 100 pounds per person over the next 20 years, that in and of itself is basically doubles global copper demand growth from where things stand today. So that opportunity is huge, and people aren't talking about it. When we were in India earlier this year, there was a huge talk that the Prime Minister had finished his big campaign promise, which was to electrify every village in India. And we found this very interesting because when you electrify parts of the country, that's really the largest source of copper demand in an economy going forward. And so we said to ourselves, how can it be that every village in India is electrified if there's only 10 pounds of copper per person and China's at 100 pounds? It just didn't seem like it made any sense to us. And so we decided to do a little bit more work on it. And as it turned out, about a month or two later, several news outlets, both in India and in the West, reported that actually only one power line would come near a village, and then they would electrify the hospital or the school in that village, and they would count the entire village as having been electrified. Now, the high-tension power line needs no copper at all, very little, but it's all the small transformers when you get into the villages and into the individual blocks that's very copper-intensive. So once this report was made, it was very embarrassing to the government and the administration there, and there's been a huge push now to rectify the situation and actually electrify the remaining 90% of the villages that have no power. We're already seeing transformer demand up 30 to 40% in some of the companies that we look at in India, and that's going to be a huge driver of copper in what we think could be a very short period of time. So we think we're watching those numbers. Again, like Leigh said before, we have mile markers that we look for. If copper imports into India don't pick up in the next 12 months, we'll have to revisit whether or not that part of the thesis is right. But you know, I think ultimately you might have a catalyst in the near term here for copper demand in India.
Mm. And now changing gears a little bit and talking about your portfolio construction, you've got in the portfolio a balance of small caps, more risky stocks maybe that can be multi-baggers, and then some other larger cap companies that give more that are more stable and less risky in principle. Maybe you can expand a little bit on how you build the portfolio and how those positions are kind of combined together.
What we do is our research process first is that we're value investors. And we find that the best time to find value in any resource market is when the commodity in that market is depressed, the companies that are operating in that sector of the market are undergoing subpar, sometimes no profitability. Valuations are cheap, investors are discouraged, and our top-down research tells us that the bear market in that commodity is over and a new bull market is about to begin. Once we would get comfortable that all those things have been satisfied and a new bull market should happen in that commodity, then we go through a very creative bottoms-up stock selection process to try to take advantage of the potential profit that will be in that commodity bull market. And the way we do it, it's a very, very careful balancing of risk and reward. Unfortunately, at the bottom of a commodity market, the marginal companies that have profitability issues, when the commodity price turns, they will go up 25-fold in price. However, if you're wrong about it, those companies could very well wind up in bankruptcy, things like that. So what we do is we very, very carefully we try to model the sector, the equity sector investments in that part of the market where we have upside, but we're also controlling a lot of risk. So it will be, we're trying to find companies that are trading at significant discounts to their net asset value, but we're also very cognizant to their internal financial positioning as far as their debt levels and their size. So we try to capture as much of that market that we can, but at the same time, we're very, very cognizant of trying to manage the risks, especially if we're wrong, because we admit that many times we don't always get it right. And we're looking for a significant part of our portfolio to be able to weather that incorrect decision on our part, and we've done this over and over again, and we're very, very cognizant of that problem that's inherited in the natural resource space, i.e. the marginal companies by far have the best potential, but are the most riskiest.
And that brings me to my final question before we open it up to questions from the audience, which is, like, you've made tremendously right calls over your career, and obviously many more right calls than bad calls, but obviously no manager in the world is perfect and make no mistakes. So I would like to understand, in your view, what were your kind of largest mistakes in commodities, and what did you learn from that?
I'll outline two mistakes. I'll give you two. One, we turned radically bullish on the global coal space all the way back in 2005. And the reason we turned bullish was that China had swung from being a net coal exporter to becoming a net coal importer. And that had huge impacts on global coal flows and prices. And basically, very quickly, we did a lot of research on that. We were waiting for it to happen. When it happened, we made huge coal investments. And coal prices, basically, over the next several years, doubled. Western Australia thermal prices went from $40 a ton all the way up to $110 a ton. High-grade metallurgical coal went from $60 a ton up to $300 a ton. Then what happened is that we rode that entire cycle. We did very, very well. And then we overstayed our welcome. And in 2010, 2011, and this is a mistake on our part, we underestimated the surging source of coal supply out of Indonesia, which I'd been to Indonesia. I'd seen the Burrito River. I said, I can't put another barge on that river. There's no way they're going to go from 180 million tons of coal exports to 280 million tons. So we missed some pieces. Coal prices rolled over. We had some investments in the U.S., companies that had severe cost pressure problems, and we overstated our welcome, and that was one of the biggest investment mistakes I ever made. Number two, I'll give you, because it's something we're bullish on today, uranium. We've made some very successful investments in the uranium space over the last 30 years. After Fukushima, when uranium prices crashed and the equity investments crashed, we made a significant investment in uranium, and that was a big mistake because we thought that the Japanese would quickly try to get their whole nuclear power business back up and running as fast as possible. Here we are now, almost 8 years after that, and of their 50 reactors, they only have 9 online. So uranium prices continued to drift lower, and we thought that they would rebound, and that was a big mistake we made. So we do make mistakes.
And what would be your current view on uranium then, looking forward?
We're very, very bullish on uranium. Given the amount of nuclear power facilities that are under construction and fully permitted today, in the next 8 years, we are going to embed in the uranium market a close to 100 million pound gap between global uranium mine supply and demand. Total uranium demand now is like 180 million pounds of uranium. In supply, we believe will actually roll over in the next several years. And we believe that demand is going to go from 190 million tons up to close to 260 million tons. So we're going to get a huge gap between supply and demand, and uranium prices have to go higher. There's no project. The most marginal project in the uranium business today needs a minimum of $50 or $60 price of uranium to even think about going forward, and we're still only $29 a pound. So you've got tremendous positive supply-demand fundamentals, and investors don't have any interest in it. So,
and I should point out also that, after we made our uranium investments post Fukushima, and we realized that was a mistake, we exited those positions, within 8 or 9 months, and we only recently have become big uranium investors again. So we have not been uranium investors over the last 8 years. That's something we got involved with again, and the reason was that, we've been watching the uranium market, and given this new demand to come online, we always figured that the uranium market would slip into deficit sometime in the early part of the next decade, 2022 or 2023. However, an event this year brought that forward by 3 or 4 years. And so when we saw that event happen, we immediately made our investments. And that was Canada and Kazakhstan both announcing major production curtailments at their large mines. And like Leigh said before, we want to get involved in a market where the industry can't go forward at the current price, and that's exactly what you saw. Cameco said, basically, why am I selling one of the best assets in the world at a cash negative loss or near break even? I'm going to leave those tons or pounds in the ground and produce them at a later date. That's the market we like to get involved with, something that the industry just can't go forward. And if we can buy good quality assets right as that turning point happens, that'll do very, very well. So we entered into that position just over a year ago.
There are a few questions here related to oil again, and you've touched on some of them, but I'll try to summarize it somehow. There's one asking about the recent surprises coming from the US oil production, and related to that, it says that common wisdom around the Permian Basin pointed to bottlenecks constraining production. But at this point, the US is at an all-time highs in terms of production. And there's also a question about the expectations on the Vaca Muerta field. Yep.
Want to do the Permian, Adam?
Sure. We're big fans of the Permian Basin. We've been invested in the Permian Basin for a number of years. I think we were probably one of the first U.S. institutional investors in that field back when Pioneer Natural Resource was proving up the southern end of the Midland Basin side, probably 7 or 8 years ago now. So we've been following that play for a long time, and we think it's very, very productive. And we ultimately think that there probably will be still substantial growth to come from it over the next 3 to 5 years. It's not unlimited. It won't be able to grow forever. And ultimately, all of that oil will be needed by both global oil demand growth and what Leigh mentioned before, which nobody now is talking about yet, disappointments in conventional non-OPEC supply. Already this year, non-OPEC supply was supposed to grow by 500,000 or 600,000 barrels. It's been revised down to basically nothing, and they've pushed it into next year, but we think that will be revised down as well. There's simply not enough new projects coming online to meet the decline rates of the base fields. The Permian Basin, like I said, that's a great shale, particularly the Delaware side. We think that there's 3 to 5 years left of growth, and it can ultimately grow probably by 3 million barrels on an upside case over the next 5 years. That's not going to be enough for global oil markets. The Eagle Ford and the Bakken, we continue to think that those fields are past their prime. Right now, companies are changing their completion techniques. They're drilling longer wells and putting more sand in the wells to try to make up for the fact that the wells themselves are less quality than the old ones. That seems to be running its course now. So if you look in the last 6 months, the number of completed wells in both of those basins are up about 40%, I think, off the back of my head. And the amount of new oil out of there is only up by a fraction of that. So you're not getting the same results that you were before. Can you continue to grow production in those two fields? Potentially a little bit further, yes, by doing larger frac jobs and longer wells. But ultimately, those wells are not in their early stages. Those are in their late stages, and will have limited growth from here. So as we've liked to say now, for the last 2 or 3 years, the entire world is dependent on 6 counties in West Texas to meet global oil demand growth. I mean, that's very, very narrow, and we think ultimately not going to be enough.
And as far as the Vaca Muerta in Argentina, the Vaca Muerta is a world-class shale. Like I said, there's only 3 shales that can really rival the shales that are in the United States, and that's one of them. Now, obviously, we're all familiar with the turmoil, the economic turmoil that Argentina is going through right now. But the other problem that Argentina has with the development of the Vaca Muerta is they just don't have enough oil service infrastructure in place. I mean, for example, when you've seen these pictures when they roll up to complete a Permian Basin well or an Eagle Ford well, all that, there's 50,000 horsepower of compression that they roll up to those sites. There's 6 million pounds of horsepower pressure in the United States. In Argentina, I think there's just there's several hundred thousand. There just isn't enough oil field service infrastructure to get the whole thing really rolling at this point. And given the economic turmoil, it's getting pushed out and pushed out. But the Vaca Muerta is a world-class shale, and it will be developed at some point. What its ultimate potential is it's hard to say.
There are a number of questions related to the fact that it seems like the market is not recognizing the value in this space. So there was one saying that what you say is so convincing, so common sense, that is almost obvious. Why does the market basically is not recognizing the value there, and related to that, why this time is different from the 60s period when commodity prices stayed under pressure for almost a decade?
It's interesting. As far as the lack of value recognition today, I should say that we've been there, done that in the last cycle. Going back to 1999, when I said before that oil bottomed at $11 a barrel, and then it proceeded in the next year and a half to rally to 37. So it went up, 2.5, almost 3 times in price. And then starting in the summer of 2011, the oil price rolled back over. Then you had September 11th, all worries about global economic dislocation, things like that. Oil traded all the way back down to 17 and bottomed. That was the bottom before it really took off. When oil was 17, it's literally 60% higher than its $11. Every oil company had made a new low. And even though oil was 70% higher, every oil company, including the big ones like Schlumberger, were lower in the fourth quarter of 2001 than they were at the bottom of January of 1999. Same thing as today. It's like we're almost repeating exactly. They say that history often doesn't repeat, but it does rhyme. It seems like the same thing is happening. What was the second part of the question? I'm sorry.
In terms of the 60s,
Yeah.
why?
The 60s were a little bit different. If you remember, back, it's hard to believe this, but remember, the world was still under the Bretton Woods gold exchange standard in the 1960s. And the United States had pegged the dollar to be convertible into gold at $35 an ounce, and the Fed went to great lengths to discourage it. And even though it's interesting, people had this belief that the Fed was going to eventually do whatever was necessary to save the dollar-gold link. And commodity prices followed what gold did. And gold didn't do anything. I mean, gold, it would rally up to 37, 38, and then they'd put it, all sorts of things happen. They put together a consortium to drive it back down and things like that through the London gold pool and things like that. But commodities just followed gold, and gold just bumped along 35, 37, 38, 35 as the U.S. tried desperately to keep it. Then all of a sudden, one day we woke up in, March of 1971, and Nixon severed the gold link, and gold went from $35 to $105 in literally 3 months. And what did oil do? Oil went from $3.50 up to $13 or $14 in literally 3 weeks. So it was the reason why that period where commodity prices didn't do anything is they were following what gold was doing, and then they broke the gold link, and then commodities went absolutely crazy.
Okay, changing gears a little bit, there's a question about uranium again in terms of your prospects for secondary supply, and I know that in your last newsletter you were referring to the fact that some investors are kind of getting to be interested through some vehicles out there.
Yeah, what's interesting about it, this is why I think uranium is so interesting here, is that, I mean, when we started to write about uranium about a little more than a year ago, we were almost shocked with the amount of interest that it generated among our investor base and the people who follow us. And what's happened since then is that there's developed a large demand from retail and institutional investors to invest directly in the metal. And we've had now 2 significant purchases of physical uranium by these investment vehicles. One is by the Uranium Participation Corp in Canada, which issued a new share and bought 2 million pounds of uranium 6 months ago. And the other was the flotation of this uranium vehicle in London, Yellowcake, which literally raised close to $175 million US and bought 8 million pounds of uranium from the Kazakhstan government, Kazatomprom. And so what's interesting about those those are closed-end funds. Once that uranium's in those funds, it's not an open-end fund or an ETF. It's not coming back. And there's two other funds that have been one. I think both have been successfully launched. I think.
Yeah, one in Australia and one in the United States.
So, as uranium demand continues, these funds are now out there. They'll issue new shares and buy it. So we could wind up with another source of uranium demand that didn't exist in the last cycle.
There's a question about, I think we've touched mostly on the commodities where you are bullish at this point. Maybe you can touch on those where you are not bullish, where you are kind of bear positioned.
Obviously, for those that follow the U.S. natural gas market, we've had a huge rally there, and people have turned bullish. We're still not bullish on U.S. natural gas. We think that, in fact, in our last letter, we said there's a high probability of a spike because the weather, it was so cold in late spring last year, and North America had the fourth hottest summer on record. So we drew inventories down low. And if we did have cold weather this winter, we run the risk of a spike. And this looks like it's happening. However, U.S. gas supply it's been surging and will continue to surge. So we think that the price spike won't last. So the natural gas market in the U.S., North America, you'd think it'd be the perfect market for us, just like I described. Value investors, people are bearish. Also, but we've tried over and over, every which way. We've done so much research on it. We just can't get bullish. The other market that I'm really worried about is the various PGM markets, platinum group metals markets. We follow that very closely, especially platinum. The fact that Europe now, I mean, even Spain is talking about outlawing the diesel engine and things like that. That puts a lot of pressure on platinum.
And on the gas side of things, if you look over the last 15 years in the advancement of the shales, on the oil side of things, your best well today is probably 150% better than your first well that you drilled a decade ago in the Bakken. On the gas side, you're drilling wells today that are 50 times more productive than you did in the first days of the Barnett. And so, that market could be impaired for a very, very long period of time. Right now, you're growing gas supply in the U.S. by almost 10 Bs a day. It's a record by a substantial amount, even though your rig count is still 80% lower than it was the last peak. So it would be the equivalent of coming back from the Permian and saying, we can drill a well that'll come on at 30,000 barrels a day and not decline for the next 6 months, and we have an inventory of 20 years of those wells. Oil would trade at $5 a barrel. That's just not happening in the oil market, but it is happening in the gas market.
Okay, there are a few other questions about commodities in general, but I'm conscious of time. So changing gears a little bit, there are a few questions on your company, on Goehring Rozencwajg as a company. One is asking about why did you decide to set up the firm in 2015 and not before? Was it more related to the cycle opportunity, or was it related to personal reasons, both?
It was personal reasons, but it was also, I was a very, very important part of Chilton. And we were significant assets of the firm. So it took me a long time to put in place the framework for me to leave, because they didn't want me to leave. So that was part of the problem. But things eventually, Richard Chilton, who runs the firm, who I had a very, very good relationship with, I just said, Richard, we all know what the hedge fund world is like. It's a very stressful place. And I've been doing it for 11 years, and I said, it's just time for me to move on to do something else. I've done extraordinarily well here. And so the timing is right. That's all I can really say. And I think it's interesting that we were able to, I think that the commodity markets, they bottomed right in the first quarter of 2016. So that's when we set it up. Very symbolic.
Okay, and in terms of assets under management, there are two questions related to that. One is, can you elaborate on your assets under management? Do you have a particular target in mind? Is it fair to say that you've been a victim of the bear market in commodities? And then, how sticky permanent capital your assets are?
Sure. I can answer both of those. I think that it's interesting to look back on history a little bit and compare where we are today versus where we've been in other parts of the cycles. I think it's important from the firm AUM perspective, but also where the opportunity is for investors today. When Leigh launched the Chilton Fund in 2005, that was 6 years into a bull market. Oil bottomed in 1998. Commodities generally bottomed at the late 90s. And so you're 6 to 7 years into a bull market already. It was a very popular asset class. And in the first 18 months, Leigh was in the top quartile of fundraisers in that space and raised about $5 billion. So it was very, very successful, and that was enough to put you in that top quartile. Then from 2011 to 2015, if you could believe this, the average natural resources equities fund lost 90% of their assets under management due to outflows predominantly. That's extreme. I mean, that is where the value is today. So here we are, we're now 6 years into a bear market. Valuations are extremely low. Commodities have never been cheaper. And we launch a new product. And once again, we were in the top quartile of asset gatherers. But that threshold, instead of being $5 billion, was now $40 million, was able to be in the top quartile of asset gatherers. So it's 99% less. And I think that tells you where you are in the cycle. Investor interest is still zero. That's starting to change now. However, that's where the opportunity is today. So our assets under management are about $50 million. There's a few larger institutions that we expect to close by the end of the year, so that number should be closer to $100 million. But still, it's an incredibly difficult time to raise money in this space, and I think that's why early movers and investors have a phenomenal opportunity today.
And that's why it's so exciting.
Yeah.
I mean, really, ironically.
And about the question about how sticky the assets are, obviously a significant part of the assets is your own money, so that's 100% sticky, right?
Our idea, one of the things we're trying to do is that we are going to be selective in who we are going to allow to become investors with us, because we don't want hot money. We don't want people that will get shaken out right at the bottom and things like that. So we're aiming for a very sticky investor base, and we've had all the money we've raised, we haven't lost a dime of it yet. So.
Yep. And I think it's also important, everyone always asks how Leigh's able to run with so few people. And I think the answer really has been that over the whole market cycle, even when assets get large, Leigh chooses never to staff up. And I think the reason is that it is a cyclical market, and you have to be prepared for lower assets one day in the future. And the last thing you want to do is have to fire your team in a very challenging period to begin with. So the business is set up to handle fluctuations in AUM as well. We're incredibly lean, and our cost structure is such that, we want to partner with people for the long term, but, our needs at the corporate level are very, very minimal.
Okay. Are there any other questions? I'll ask just the very last one, which I've got here, about China. What do you think about China? I guess it's related to whether if you think that there's an excess there in terms of credit, and whether that could impact commodity prices.
It definitely. I mean, the big wild card for natural resource investors is will there be some sort of implosion of the debt bubble in China? And that's a risk. All I know is that all the 20 years I've been going to China, everyone has been worried about this for the last 20 years, that China was going to implode. It hasn't done it yet. It will happen, but I suspect that it's going to be some point in the future. So I don't think it's going to be imminent.
I said it was the last one, but it wasn't. Can you elaborate more on the S-curve effect on commodities?
Sure. So the S-curve is something that we've been working on for a very, very long time. And effectively what we look to do is we look to put a graph, and on the x-axis is real per capita GDP, and on the y-axis is commodity demand. In the case of oil, that's the most famous S-curve that we use, and the most famous example is South Korea. So in the 1980s, South Korea doubled its GDP and quadrupled its oil demand. And what happens is you basically start out with a very poor country, and a change in the real per capita GDP has a very small impact on natural resource consumption. Subsistence farming and things like that variances year to year in crop yields doesn't have a direct impact on oil demand, what have you. Then all of a sudden you hit a period where a country's population has earned enough money that they have a little bit of surplus capital and they can start to invest in things like first motor scooters, and ultimately cars, and then ultimately trucks. We could talk about India. It's so fascinating. You know, when we went, there's hardly any motor scooters left on the streets. Everyone is in the major cities. Everyone's already moved on to cars. And then you have this period of accelerating demand growth, and then ultimately you plateau and level off. And that's a country like Western Europe and the United States, where changes in GDP don't have an immediate impact on oil demand. You've saturated, every home has 2 cars, et cetera. The issue is that most people extrapolate a straight line between demand and wealth, and that works for most of the time. For instance, if you look at the OECD world, you can extrapolate a straight line. If you look at emerging markets that are very early, you can extrapolate a straight line. But there is this moment where it accelerates and it hits an inflection point, and that's what we call the tipping point. And over time, the number of people going through the tipping point at any one time has always been about 700 million people. So some countries will enter into it and other countries will exit, but it's always been fairly consistent. And beginning in 2003, with the rise not only of China, but also countries like Indonesia, Vietnam, the Philippines, Thailand, and now the rise of India, you're at an unprecedented time in history where 4 billion people approximately are going through this all at the same time. And that, A, is having a huge impact on demand, and B, it's having a huge impact on people's models. So that's why firms or organizations like the IEA aren't picking up on this, because they're used to a more steady state of affairs, projecting, not the inflection point.